Welcome to this episode of Into the Multiverse, where we're going to talk about whether multi-asset investing makes a lot of sense when the market is in a downturn. For those investors who've been in the markets for the last year or so, the bulk of 2024 was a good experience, and then you went into September, and from September you had a drawdown period almost until March. And April has been a month which has been more rewarding. So investors have already felt how bumpy equity investing can be in the last 1 year or so. And it makes sense to think about whether there is a solution that can give you the same kind of results without the same kind of uneasiness that you might go through in a market downturn. So we think that there are three powerful reasons why multi-asset investing can actually be your friend in tough markets. And let's take a quick look at what those three reasons are. So the first point is low correlation investing. Correlation is a wonderful and elegant mathematical concept which basically helps us understand the relationship between two entities. So when you have a high positive correlation, then these two elements are going to react in the same manner to the same external events. When you have negative correlation, they're actually going to move in opposite directions. And when you have a low correlation, it's difficult to assess in which manner this moves. So correlation between asset classes is an important factor. When we look at how equities are correlated with fixed income or precious metals or global equities, then you realize that there is some diversification benefit that comes out of this, which essentially means that in a wider range of scenarios, your portfolio has the capacity to perform when you add all of these elements into it. The basic idea is that when you have assets of different correlations in a portfolio, they're not moving in the same direction at the same speed, but it also doesn't slow you down, which is why this solution is so elegant. This brings us to the second point of dynamic risk management. Most investors need a product that can dynamically manage the risk that emerges from markets, which essentially means that you're responding as the market cycle changes, you're responding to new economic conditions. For example, we were in a high growth phase, we have now moved into a low growth phase. You've had expensive valuations, and then you've had a volatile market, you've had FIIs come in and come out. So when your product is able to dynamically adapt to these situations and manage risks as they emerge and evolve, then you're in a better wicket in terms of wealth creation. If you have to dynamically respond to each situation that comes in, then your level of involvement as an investor actually goes up quite a bit, and you might need to have a hand in deciding where to allocate capital at each given point of time. So a product that can evolve and respond to risk is more suited to an investor who wants a more hands-off approach to investing. And this is exactly what Sphere does by making these lateral shifts into asset classes at the right time. So you're looking at valuations and relative merits across the board and then deciding where capital goes in. So the investor doesn't have to think about this anymore. I want to take a quick minute to walk you through the performance and risk management measures that we have in Sphere PMS. The 1 month performance for Sphere is about 4%, and for the benchmark, the NSE Multi-Asset Index 1, it's about 2.17%. If we move on to 3 month performance, it's at 7.85% for Sphere versus roughly 2% for the benchmark. The 6 month performance is about 3.39%. For the benchmark, it's at 0.36%. The 1 year performance for Sphere is about 20%, and the benchmark ranked at 7.5%. The 2 year performance for Sphere is at 30%, almost double of the benchmark at 15%. The 3 year performance is at 25% for Sphere and about 11% for the benchmark. The since inception performance for Sphere is about 23% versus 10% for the benchmark. Markets went through a volatile patch from September last year till now, and we thought it would make sense to look at the drawdown data for this period. So if we look at Sphere's peak to trough drawdown, we've lost about 10.5%, and our trough was at January 13th. In this time frame, the Nifty lost close to 12%. If we look at the Nifty's peak to trough drawdown, this happened on 4th March, and the Nifty lost about 15% from its peak in September 2024, whereas in this time frame, Sphere only lost about 10%. So clearly, Sphere has been able to handle drawdowns in a much more effective manner than the Nifty. And now to quickly look at the drawdown numbers, which show us how we fared against the market across different points in our timeline. So when we look at these two data points in conjunction, what we realize is that Sphere has managed risk effectively. So you see that you have a lower drawdown than a pure equity index and a slightly higher drawdown than a multi-asset index. At the same time, we've not compromised on returns for any investor. So you can see that the long-term run rate has been pretty good and you've been able to outperform the index as well as even equity indices on a long-term basis. So keeping all of this in mind, a multi-asset solution could actually work for a risk-averse as well as a return-conscious investor. And this brings us to the third reason why multi-asset investing can actually serve you well in a market downturn. And the third reason is that you can be a confident investor. Now, the most important thing that defines an investor's success is how consistent they're able to be. When you are confident as an investor, you tend to be more consistent. And when you are consistent, you're going to get all of those benefits that come out of compounding. In a product where you have multi-asset investing, which is less volatile, more rewarding, then an investor has the ability to sleep well at night and make investment decisions on a continuous basis. Otherwise, what tends to happen is you're trying to catch market trends or you're trying to wait for certain events that will trigger your wealth creation decision making. So with this kind of product, you're able to participate continuously in the markets. You don't have to worry so much about timing the market or what's happening there. Instead, you're focused on your milestones and the goals that you want to achieve. So this shift in mindset actually helps you accomplish more, and it's all down to how confident you are about the products that you invest in. Before we come to the close of this video, let's take a look at the landscape. We are heading into an era of a lot more uncertainty simply because of how global economies are slowing down, global policy has been fairly volatile, and geopolitical risks have begun to emerge. This is a lot for an investor to worry about, and a multi-asset approach to investing could actually help you set aside some of these worries and invest in a stress-free manner through the tougher times in the market. If you would like to have a productive conversation on what Sphere can do for you, then get in touch with us on WhatsApp at 9500027285 and we'd be happy to partner with you on your wealth creation journey.